How worried should we be about a potential government shutdown once we blow through the deadline tomorrow at midnight? Democrats in the Senate, they're filibustering the Republican budget bill. They want to extend the health insurance subsidies in the Affordable Care Act, reverse some of the president's recent Medicaid cuts. So far, it sounds like that both sides are pretty intransigent. And if you look at the predictions market, they're currently assigning a roughly 75% odds of a shutdown by Wednesday. It's always unnerving when we see these headlines out of Washington, isn't it? But how much will any of this truly impact your portfolio? If history's any guide, not that much. Just because the story makes you feel bad about the government or the country as a whole, that doesn't mean it matters to the stock market. On Friday morning, analysts at Bank of America published a review of the last 6 government shutdowns dating back to 1990. And what they found is that 4 out of 6 times stocks actually went up from 1 week before the shutdown to 1 week after. The S&P 500 hasn't really been hurt by this stuff since the Clinton administration. Of course, there's a difference between a partial shutdown and a full shutdown. Right now, not a single appropriation bill has been signed into law. So if we go over the deadline, we'll effectively have the first full shutdown since 2013. But in 2 of the last 3 full shutdown, stocks have gained ground with an average gain of 1% for the week before to the week after. What else can history tell us? Usually during a government shutdown, the dollar gets hit versus foreign currencies, although not very hard. I'm not going to complain about a weaker greenback. It helps our earnings per share when companies do the currency translation. On top of that, past shutdowns haven't done much to Treasury yields. Now, I want to distinguish between the government shutdown, which we're facing now, and the semi-regular debt ceiling fights. When our leaders play chicken with the debt ceiling, that freaks out the markets because it jeopardizes interest payments on U.S. Treasuries, and we can't have that. But we just raised the debt ceiling by $5 billion this past summer as part of that One Big Beautiful Bill Act. So even if we get a shutdown, we can keep printing money to our bondholders. We're very good at that. The one area where a government shutdown really could hurt is employee furloughs for people who work for the federal government. Here it could be not so hot for them. Analysts at Bank of America and Deutsche Bank have estimated that an extended shutdown could result in furloughs for roughly 800,000 federal employees. Goldman Sachs could be as high as 900,000. Either way, that's a lot of people who won't be getting paid for the duration. And people who don't get paid, well, let's just say they can't buy things. How much damage could these furloughs do? Bank of America says each week of a shutdown could knock 10 basis points off our GDP growth in the fourth quarter. Goldman says it's 15 basis points. Deutsche Bank says it's 20 basis points. In other words, a week is fine, but once we're talking 3 or 4 weeks, that represents a serious hit to the broader economy. That said, all of the analysts seem to agree that once the shutdown ends, our GDP growth should snap right back, unless the government closes up shop for a long time. It's not that disruptive. And unlike the last time this happened in 2013, we don't have a debt ceiling crisis, so the bond market's safe. All that said, there's one thing I'm at least a little concerned about. It's the potential interruption of economic data from the government. When the Bureau of Economic Analysis and the Bureau of Labor Statistics are both forced to go on vacation, and they will be, that delays some major data points. We'll have much less insight into the inflation or the labor market. You know how important those numbers are. If you look at what happened in 2013 when the shutdown occurred at the exact same point in the calendar, some key pieces of data got delayed by anywhere from 1 to 3 weeks, which is what you'd expect from a 16-day shutdown. That month, the September 2013 jobs report was delayed by about 2.5 weeks, and the September CPI report was delayed by about 2 weeks. The October reports for those data points were also delayed that year, but by less than a week. In the grand scheme of things, these delays aren't a huge deal. Right now, we're in a critical situation where the Federal Reserve needs this data in order to be able to decide whether to keep cutting interest rates. With the next open market committee meeting in a month, Wall Street overwhelmingly expects another quarter-point cut. I do too. But I worry about what might happen if Jay Powell doesn't get the data he needs to make an informed decision. He can't wing it. Maybe the Fed becomes more hesitant if they feel they're flying blind on jobs and inflation. I get that. Then again, given that a government shutdown is bad for the economy, that might make it actually easier for the Fed to justify rate cuts. I think that that's a reasonable proposition. Long story short, it looks like we're headed for a government shutdown tomorrow, okay? Tomorrow night, midnight. But while that's definitely not great news for America, history says it's not that impactful for your stock portfolio. Like I mentioned earlier, over the past half dozen government shutdowns, there's been no clear trend for what happens for stocks. On average, They actually gain ground. Please remember that when the people come on and scare you, they don't know what they're talking about. There does seem like to be a negative impact to GDP from a government shutdown, and perhaps a meaningful one if the shutdown drags on for more than a week or two. But the good news here is that those negative impacts tend to reverse in future quarters, assuming the furloughing of federal employees doesn't turn into permanent firings. By the way, that's something the Trump administration has threatened to do. But here's the bottom line. I'm not worried about most of this stuff. My biggest fear is that a shutdown will delay important pieces of economic data, making life more difficult for the Federal Reserve and potentially postponing their plans to cut interest rates. I still think that's a long shot. Honestly, though, if the biggest fear from a government shutdown is delayed data collection, well, that's not a reason to be concerned. When it comes to government shutdowns, my message is simple. Keep calm and carry on, because the stock market tends to do just fine in these situations. Mad Money's back after the break.
Coming up, shares of this recent IPO keep hitting lower and lower notes. So what gives? Cramer's giving you a front row seat to his analysis of StubHub. Next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.